What is going on, investors, and what is going on, the audience of Cartoon Brew? My name is Colin Teddards, and here on YouTube, I host a channel called the Investor Channel, where every quarter companies give an update on their financials. They give investors a view into the company's financials, the profit and loss, the cash flows, the balance sheet. And on our channel, we review those documents. And a lot of times we go really fast because the vast majority of people are watching are relatively sophisticated investors. But one thing I love to do is actually teach people that haven't had the experience of going through these financial documents, maybe didn't attend business school, maybe in a completely different industry. I love to try to teach them the basics of reading these financial documents. And so on today's video, you're going to learn how to read a profit and loss statement. You're going to learn how to read a balance sheet. You're going to learn how to read a cash flow statement. And we're going to do it in the context of Disney Company releasing their Q1 earnings today. The company made several announcements, including layoffs, the plan to bring back a cash dividend for investors. We'll talk about why the company is having to do these types of things. And as we roll through the financials, you are going to learn a lot, not only about Disney, but also how you can apply that to maybe other media stocks that you like a Netflix or Warner Brothers in that case, maybe a Paramount, maybe a Comcast, or any public company that you want to invest in. I hope you learned something here today. And if you have any questions, feel free to leave them in the comments below. I'll try to return back to this video and answer as many as I can. Let's jump into the documents and take a look what's going on over at Disney. So the first and foremost thing that most investors pay attention to is really, kind of what the stock price is at any given time, and then maybe what it's done over maybe the past year. And we've seen the Walt Disney Company over the last year, like a lot of stocks, is actually down about 21%. This time a year ago, stock was up over $145 per share. Now it's trading about $111 per share. But in the after hours, after the company reported their earnings, every quarter, so every 3 months, these companies actually release earnings. And in the case of Disney, they actually do it after the regular trade of the stock market. Stock market only trades during a certain window of time. And then after that cutoff, the company decides to announce their earnings. Investors get to digest it overnight. And then when the stock market opens up tomorrow, Disney stock will resume trade. Well, it appears that investors like what they see. Stock's going to go up potentially over 5%, largely on the news that the company is actually going to fire. Yeah, that's right. They're going to fire 7,000 people. So certainly if you're one of these 7,000 people that are going to lose your job over at Disney, it is a sad day. But for investors, this likely means reduced cost. This likely means higher profits. So on today's video, understand we are going to be viewing this from the view of an investor and help you understand that view, as some of you might be an employee of Disney. Some of you might sell your content into Disney. Some of you might have a relationship with Disney or other media companies. It's going to help you understand this from an investor point of view because, look, Disney's job is to thrill you at their theme parks, thrill you at a movie, have you turn on their channel and consume their content. But being a public company with publicly traded stock, their actual number one obligation is actually to investors in the company. And that is why the company is quick to cut 7,000 jobs, restore a cash dividend, which the company used to pay in the past and did so consistently. Essentially what a dividend is Disney pulls profits out from their pocket and distributes it to anybody that owns a share of Disney. Think of it like maybe interest on a bank account or maybe a bonus you receive once a year or once a quarter from a job that you might have. This is obviously great if you invest in Disney stock, but if you have a job there, might mean it comes at a sacrifice because the company does have to take care of its investors. Now, if you want to find the financial documents, there are plenty of sites that have them. I find the easiest way to find financial documents with any public company that you're looking at is go directly to the company's investor relations website. And how do you find that? You simply put the company name into Google, and then I follow it just by IR, which again stands for investor relations. When you click on the investor relations website, it'll take you to a page. Usually it has some kind of stock quote, has some recent press releases from the company. Maybe they're announcing a new movie. Maybe they're attending some kind of investor conference. It tends to all be investor related. Now, the more important thing though you get are two types of reports. There's an annual report, which comes out once a year year and really recaps the company's strategy. It's a little less specific on the financials. On today's show, we're going to go through what's known as a quarterly release, something that is released every 3 months that is heavy on financials and heavy on things that are pertinent to investors at the moment. The annual reports tend to be more of a broader overview of the company and certainly worth reading, but most investors tend to focus on these quarterly reports. And you'll see this came out February 8th, so a very recent report. And at the top of these, it's always stuff that the company wants you to see, that their revenues grew, their earnings per share was decent enough. You tend to get a statement from the chief executive officer at the top as well, talking about how great things are, significant transformation. They'll use all type of corporate speak at the top. It'll tend to be followed by very brief and abbreviated financial statements, which you certainly can skim through as an investor, and I certainly do this, but we'll get into these in more depth. Typically, the best part of these financial documents actually happen a little further down. So I tend to just gloss over the first couple of pages because actually it's exactly what the company wants you to read. Now, this isn't the case with all companies that you will look at, but in the case of Disney, they have different segments of the business. They obviously own ABC, they own ESPN, they own other networks, they have the movie business, and they have the all-important Disneyland, Disney World, and the Disney Parks and Experience business. So you tend to look at this company actually in different segments since they are quite different. Going to Disneyland is completely different than going to a movie, and then watching an NFL game on ESPN is somewhat different than all of that stuff. And so the company tends to divide things into different segments. And the first thing I always come to when I look at any Disney report, and that includes today, is I come down here to segment revenue. Revenue is exactly what it sounds. This is money that is coming in the door. These are all the ticket fares over at Disneyland. This is all the revenue that they get from Disney Plus. This is revenue they get from movies. This is revenue they get from cable affiliates. This is all the money that comes into Disney. And they lump their media business and their entertainment division all into one. It sounds like on the conference call that is followed by all these reports. So what the company do is they release these financial documents, and then what happens is the CEO, like Bob Iger in this case, gets on a conference call and he explains things a little bit more. And some companies, including Disney, actually reveal more stuff on the conference call than what was contained in these financial documents that we'll go over. He revealed the job cuts on the conference call. He aimed to restore the dividend. He talked about that on the conference call. The other thing that is not mentioned in this top headline is he is going to restructure Disney's business into 3 different business units. You have Disney Entertainment. This is going to be your movie business. This is going to be ABC. This is going to be your Disney Channel. This is going to be the entertainment division that is almost wholly owned, if you think, by Disney. Then you're going to have ESPN, which actually licenses most of its content, its key content, from the NFL, the MLB, the NBA, the sports leagues. And then finally, you're going to have your Disney Parks and Experiences, along with the products, which are all the toys and the trinkets that you buy at these types of places. That is going to be a third division. But we will have to wait till next quarter to kind of see that broken out. In this segment result, we get the media business, which is all the TV, movies, all lumped into one business. And what you'll see here, again, on the revenue side of the company, we have a 1% change. That is not necessarily that good, especially in an inflationary environment where the price of eggs and lettuce and all the things you're buying continue to go up. The fact that the company actually only grew their revenue by 1% actually is essentially a decline. So you went from 14.6 billion. And again, these are in millions. So some of you might be saying, well, Disney had way more than $14,776 worth of revenue from their media business. That is because these figures are in millions. To condense these and get them to fit them on a page and make them a little bit more palatable to read, this is not 14,000. This is not 14 million. This is 14 billion with a B. And so you see year over year, look, 14 billion. And some of you are immediately going to say, how does a company with $14.8 billion worth of revenue have to fire 7,000 people? And we're going to go through that from an investor perspective. They don't have to do it, but remember what I told you at the top. Disney's number one obligation is actually to investors. And as we walk through these financial documents, you're going to see that they probably actually do need to make some cost cutting over at this company. And here's the most important thing when we're talking about the media business. We'll talk about the parks here to a lesser degree, but I want you to understand the media business over at Disney. So you have your revenues here at top, and then you have your operating income down here at the bottom. And if the number is in parentheses, that's a negative number. Anytime you see in the financial world a number in parentheses, it's actually a negative number. I almost never see kind of a minus sign or a negative sign. It's always in parentheses. So when you see parentheses, it means it's a negative number. So here's your operating income. That's a fancy word for profit. So you have your revenues up here. Think about this like a lemonade stand. This is all the money that you got for selling lemonade. And here's your operating income. This is after you paid for your lemons, your cups. Maybe you had to build a stand. Maybe you had to rent something at a food fair or a farmer's market. Maybe you had to pay an employee. You had to buy a truck to get it there. After you pay all your expenses, here's your operating income, or essentially your profits. Notice this company on their media business off of $14.8 billion. Again, I'm going to round some numbers. Very common to do in the financial world because there's not much of a difference between $14.77 billion up to about $14.8 billion. Here's the key thing to understand about that business. Again, this is your ABC, ESPN movie business, all your television. You actually lost money in the most recent quarter. Again, we're looking at this from a quarter perspective, and this quarter ended in December. So this is October, November, and December of last year for Disney. We're finally getting these results. Obviously, they have to be tabulated and compiled by the financial experts over at Disney. And then finally, we get them maybe about 30 days or so after the quarter essentially ends. The company lost money in their TV business. So when you see that they're firing 7,000 people, understand that yes, this company is worth over $200 billion. If you were to buy every outstanding share of Walt Disney Company for $111 per share and some change, you'd have to come up with over $200 billion to buy all of them. But understand, you would be buying a company that is actually losing money airing TV shows, sports programs, and movies. Now, the good thing is over at Disney is they have Disneyland and they have Disney World off of $8.7 billion worth of revenue, which was a 21% growth year over year, more than outpacing inflation. Take a look at your operating income in Disneyland. Oh my goodness, you made $3 billion. This is just incredible. Off of $8.7 billion worth of revenue, you made $3 billion in profit. That's fantastic. That is up 25% year over year. Anybody that's attended Disneyland understands they've jacked up the prices. They've added new little service layers. And so they're able to charge more and they are making more money. So off of the total $23.5 billion. So when you factor in the TV, the movies, the sports, and then you combine that with the parks, the company had $23.5 billion worth of revenue, and they made, or the profits from operating those businesses, they made about $3 billion. But here's the rub. It's actually down year over year. So they actually went down 7% year over year. Last year, they made $3.3 billion due to the fact they actually made money in their entertainment division, over $808 million. So there's your problem over at Disney. And it's kind of a first world problem, right? You have these investors that want more and more out of this company, and they are disappointed by the fact that their media division is not making money. Yes, they're happy with the parks and they're happy with Disneyland, but they understand there's a limit to how much you can charge for a family to go to Disneyland before people stop going. You also had that pandemic for a little while that really actually hurt this business. So you have some pent up demand in this business. So some investors are thinking, well, this time next year, maybe all the families that went to Disneyland and spent a bunch of money, maybe they're not going to go again the following year. So this business growth rate from a revenue and a profit perspective might come under pressure in subsequent quarters. And so we're going to have to rely on this media business at some point. And not only that, it's not sustainable to run a business at a break even, or in this case, a loss. So the company's got to make some changes, and right off the top, they're going to eliminate about 7,000 jobs and do some cost cutting across the board, especially from the content side. Now, get more view of this as we dive into this Disney Media and Entertainment Division, because the company inside the media division, as you all know, they have the linear networks. This is your ABC. This is your ESPN. Then they have the direct to consumer. This is mostly Hulu, ESPN Plus, and obviously Disney Plus. And then finally, you have content sales, licensing, and other. This is actually your movies here. So I would assume a lot of you probably are looking at this and you see the blockbuster movies like a Black Panther or an Avatar, and you think this is just a gigantic revenue stream. And actually, it's in third place for Disney. That's how big this company is. Take a look at your linear networks. This is all the affiliate fees that you get for airing ESPN on maybe like a Google TV, certainly like a Comcast or any kind of cable DirecTV subscription. They pay Disney every month for the right to air ESPN and all the other networks. On top of that, the company airs advertising and gets sponsorship on different types of programs. That's a $7.3 billion business, but you do notice that is actually down year over year by about 5%. Now, you have the fast growing direct-to-consumer business. Again, this is your Hulu's, this is your Disney Pluses. That comes in at $5.3 billion. That was up 13% year over year. And then finally, you have your movie business, which is relatively steady. Okay, during the pandemic, this would jumped around a little bit more, but relatively steady. You're looking at about a $2.5 billion business on a quarterly basis for those movies and those other kind of licensing of content. Now, here's your operating income. Okay, we just talked about revenue. Again, revenue is the money that comes in the door for Disney. The operating income is the profit, or in this case, when it's in parentheses, remember on any financial documents, a number is in parentheses, it means it's a negative, it means you lost money. Here's your linear networks. Again, ESPN, ABC, Disney Channel, that made money, okay, to the tune of what, $1.3 billion, but it is down year over year, down 16%. So you lost ground on the revenue side and you lost ground on the profit side as well. Here's the big problem over at this company. Here's your direct to consumer. Everybody's talking about Disney Plus. Everybody's talking about these streaming networks. Well, unfortunately, they don't make money. You off of $5.3 billion worth of revenue, you lost $1 billion. We're not talking about for a year. We're not talking about for like 5 years. We're talking about in 3 months. So you're burning through $300 million a month on that direct to consumer. A lot of this is advertising, content costs, server cost, all those types of things. You are losing money in that business. And here's your movie business. Now, there's probably some weird accounting things, the way they have to account for these movies. Obviously, if you release a movie, let's say in November, or a lot of movies actually get released kind of in December for kind of a December release, you're obviously not realizing all those ticket sales in the quarter. Again, this is the quarter, October, November, and December. So clearly, Disney is going to continue to make money off of Avatar, off of Black Panther. And so you notice in the quarter, off of $2.5 billion worth of revenue from the movie business, you actually lost money, about $212 million. But again, it's likely more due to accounting than those movies actually performing poorly. As you all know, they're going to just continue to rake in money on those movies over time. It's kind of a longer term from a profit perspective. The company does break things out domestic, which I would assume is probably United States and Canada, and then they look at kind of at international channels as well. For the sake of the video, we won't really get into these numbers, but there can be some situations where maybe one region is outperforming the other. And certainly if you are tapped into kind of the international market or just the domestic market, you might pay a little bit more attention to the different geographical segments that Disney or any media company that you're looking at tends to operate. Now, the great thing about a lot of these financial reports is they do explain things in plain English down here. They talk about how they had lower NFL and college football rights cost, but they had an increase in production cost. They talk about the different kind of scheduling down here. They talk about the international channels. They come down here and they talk to you about the direct-to-consumer business. So if you're looking at these financials and you're still a little bit of fuzzy on revenue and operating profits and growth rates and kind of year over year on a quarterly basis, you can come down here and read through these types of things and actually get very granular details on the fact that there weren't as many cricket matches airing, and so that reduced cost and likely reduced some of the revenue that the company was able to produce. Same thing for the direct-to-consumer business. It explains it in somewhat plain English, so don't be too scared if you don't understand all these numbers. there is some plain English in here, and it's certainly worth reading from that perspective. Now, here's a great thing that I basically come to this second when I look at Disney. I look at the different segment results. I take a look at revenues. I take a look at operating income. And then I want to come down here and look at paid subscribers, because as I showed you, this segment of the business doesn't make money. So off our direct consumer business, again, $5.3 billion worth of revenue, we lost $1 billion. That's a problem. So how are we going to turn that around? How are we going to make money on Disney Plus? How are we going to make money on Hulu? How are we going to make money on ESPN Plus? We've got to grow the number of users, the number of people paying, or we've got to jack up the price. One of those two things have to happen. Or I guess the third thing is we got to slash cost. Okay. And what I'm seeing over in the paid subscribers of the direct to consumer business is this business is no longer growing. And so that's a problem. Okay. So you have your total Disney Plus subscription. That was actually down. That's a problem. This actually isn't year over year. This is essentially quarter over quarter. You'd always want to kind of check your time change. My guess is if you look year over year, you still have growth here, but now we're kind of looking at this kind of in a sequential quarter over quarter type thing, and we're down there. So it means people are essentially canceling their subscription of Disney Plus. You had some small growth in ESPN Plus, and you had marginal growth in Hulu. That is showing me that that's a problem. If you're losing $1 billion in a business and the customers aren't showing up incrementally in more amounts, that is going to be a problem. You're going to have to raise subscription prices, and it appears that Disney tried to pass on some price increases. I know that they've raised price year over year. Again, what we're looking at is kind of a sequential kind of end of October to the end of the quarter. And so they tried to raise prices, but it definitely impacted the number of people that subscribed to the channels. Doesn't appear to me, and just in the competitive environment where you have all these different streaming services, there is kind of a cap that you are able to charge for these types of things before maybe people binge in 1 month and then cancel, or they don't sign up at all, or they come here to YouTube and watch videos for free. So Disney's in a little bit of a tight spot when it comes to this. They described again on the conference call that they are going to do cost-cutting measures on the content side. Some of it is going to be employee or job related. The other part is actually going to be cutting content costs. I don't know if that means cheaper production value or if they're going to cut the budget on the type of products and type of TV shows or media that they're going to bring in, or how they are going to do that. And they're not going to be able to do it on the sports side. Okay. You can't go to the NFL or the NBA or the MLB and say, we're going to pay less, because guess what those leagues will do? They'll go over to Apple, they'll go to Amazon, and they'll go to Google, and they'll say, how much do you want to pay? And that's basically the problem ESPN and Disney is finding themselves in with the sports business, is they're going up against multi-billion dollar and in some cases trillion-dollar market cap companies that have way more money than these companies for those sports rights. So they're in a tough spot. They've got to turn some things around. It's not going to come, it appears, from subscriber growth. If these subscribers were just growing exponentially, double digits, I wouldn't be worried about losing $1 billion in a quarter. But now we've stalled out on subscriber growth, and there is a limit to what you can charge for these types of things. And so Disney is in a tight spot to a certain degree there. Now, again, down below here, they explain some of these things like I talked about in plain English, some of the decreases or the increases in pricing. If you're interested in the movies, here's your content sales and licensing. Essentially, they make a movie and they license it to the different movie theaters and those types of things. They talked about how in the most recent quarter, they were led by Black Panther. And then if you look year over year, there's going to be movies that they were releasing last year that were pretty good, and then they released maybe some movies last year that weren't that good, and so it kind of offsets from a profit perspective. They also, just as a footnote here, one of the most successful movies of all time, in our most recent quarter, we released Avatar: The Way of the Water and Strange World. So some of these movies that are big and get a lot of attention are almost a footnote when it comes to this company. This company is big on the Disney parks and experience from a profit perspective, the Disney Plus from a revenue perspective, but that is driving a lot of the losses. But clearly ESPN, ABC, your linear networks, still with those affiliate fees and those advertising on those networks, is a gigantic gigantic business. We'll skim through the parks and experience. I think you understand that that business is just doing fantastic. They show you here essentially the parks from a domestic and an international perspective, both on a revenue and again, a profit perspective. They'll go through some other financial information down here. These tend to be small numbers, and by small, I'll put that in air quotes. On a company with $25 billion worth of revenue, 52 million, 69 million. These aren't large sums of money. They're essentially rounding errors. Now, the company also has a a non-controlling stake, essentially a small investment in the DraftKings company, which is a daily fantasy and kind of a sports betting site. They have to recognize, based on DraftKings is also a public company, they have to recognize the value of that investment quarter to quarter based on how well DraftKings stock is either doing or not doing. So they discuss that here. Anytime you're looking at a company like Disney, this company has a fair amount of cash. We'll get to the balance sheet here in a second, but they also have a lot of debt. Okay, this is a company with over 40 billion, with a B, $40 billion worth of debt on their balance sheet. So in some cases, they're paying interest on their debt, but they're also earning interest on the cash that is essentially sitting in their bank account. So you have this net interest expense that is described here. We'll go through that a little bit more on the profit and loss statement as well. Disney makes investments into sometimes probably different movies, but also different television networks. So they have to recognize that from accounting perspective. Again, relatively small numbers in the grand scheme of things, large numbers, but in the grand scheme of things of a $200 billion company, $191 million is not a whole lot. We'll talk about income taxes here in a second. Again, non-controlling interests where they have interest in some kind of piece of software or a streaming service, in this case, owned partly by Major League Baseball and partly by Disney. They have to recognize these things from a financial perspective. We'll get to the full cash flow statement here in a minute. It'll make more sense if I walk through it in the order that is appropriate, but they give it to you here in a condensed view. They also talk about capital expenditures, which is like building all the different stuff at Disneyland. We'll talk about capital expenditures and depreciation in a little bit more. You'll see with these financial documents, they look long and complicated, and they're kind of daunting to anybody that's new to investing. But once you understand them, you understand that you are skimming through like 80 to 90% of this, and you're just getting to the pieces that matter. And I'm showing you that here on today's video. If you tune into the investor channel here on YouTube, I basically cut all of this out, and we only focus on the pieces that over 20 years of reading these financial documents, I think are pertinent to investors. Here they're describing their product offerings, which again, if you're familiar with Disney, you understand these things. They talk about the definition of paid subscriber, the average monthly revenue, how they recognize. A lot of this is kind of boilerplate type stuff. Again, we come down to free cash flow. This isn't your cash flow statement. This is a condensed version. I tend to skip over these things because I'll teach you how to read a full cash flow statement. Again, I talked about how the best stuff is actually at the bottom of that, and we're getting there. Okay, hang on. We're getting to like the best stuff in these financial documents. Again, more kind of boilerplate stuff. You don't really need to know about these types of things. Forward-looking statements, they're just telling you, hey, we're looking forward. We're going to make some assumptions about the future. Pandemics and all those types of things can come up, and things might change. That's what they're telling you basically from a legal perspective. Now, here's probably the most important document. I mean, we're all the way down here on page 14. Here's the most important document on the entire finance statement from Disney. Now, if you take anything from this video, it's to learn how to read a profit and loss statement. Now, in the financial world, they call it the condensed consolidated statement of income. Sounds super formal. This is just a revenue, an expense, and essentially a profit statement. There is a top line. Most of you are probably familiar with that. A top line is your revenue, again, the money that comes in. And then there is a bottom line, which tends to be represented by two successful black lines. So your top line is here at the top. Your bottom line is represented by two black lines. That's your profit, essentially, what the money you take home after the revenue, and you hope there's not parentheses around that net income side. So the company, as we talked about, $23.5 billion. Again, this is in a quarter. This is in 3 months. That is an increase year over year. You tend to be comparing things on a quarterly basis year over year. You went from 21.9 up to this 23.5. Here's your costs and expenses. This is all the salaries. This is the content costs. This is the software costs. This is all the advertising and marketing that the company had to do in the quarter. Take a look. $21.5 billion. So off of $23.5 billion worth of revenue, sounds great, but boy, you had to spend $21.5 billion to get that. Now you have some restructuring and impairment charge, rather small. You do have your interest expense, rather significant, okay? $300 million in a quarter. If you want to times that by 4, because they're paying this interest every quarter, you're over $1 billion just in interest, okay? So the bankers love Disney. They're making lots of money. So after you pay some other expenses and get some income, here's your income from operations. And I tell you what, this is where we stop usually on the investor channel. All I care about with this company is what money they're making operating the business. Underneath this, we'll get income taxes. And if you follow anything going on in Washington, income taxes and the rate that the corporations pay, it changes depending on who's the president and who's passing the laws. Some other things not in Disney's control could also be down here, like the performance of DraftKings stock or performance of other investments that they have, not necessarily related to running Disney. So you see, they label it here, income from continuing operations. This is essentially what's also known as operating income. It was at 1.77, we'll call that $1.8 billion in the most recent quarter. So off $23.5 billion worth of revenue, you cleared about $1.8 billion to the operating side. Last year, we were closer to $1.7 billion. Now, if you want to pay your income taxes, which you probably should do, and all those types of things that these corporate companies have to do, you come down to something called net income. This is after everybody gets paid. The bankers for the interest on the debt, the government for the taxes, all the employees, everybody gets paid. You cleared $1.279 billion worth of net income, again, off of $23 billion worth of revenue. So this company actually doesn't clear a ton of money down here. I know $1.3 billion is a lot of money, but in the context that you took in over $23.5 billion, it's actually not a lot. And so that's one of the reasons why, if you look at the stock performance over the last 5 years, hasn't gone up very much, just 8% over the last 5 years. In fact, 5 years ago, this stock was $103. And so it's literally gone up $8 in 5 years. And a lot of that is due to the fact that while the revenue number is impressive, a lot of that gets chewed up in costs. And so that's why you have to bring in a CEO that is going to do some very tough cost-cutting measures. Notice last year, you cleared a $1.1 billion. You flow down to things like earnings per share, which is essentially this net income number divided by the number of shares outstanding. So again, if you were to buy up every single Walt Disney share, you'd have to pay $111 per share. If you bought them all, you would pay over $203 billion for the company. When you see something called earnings per share, it's also abbreviated EPS. That is the net income divided by the number of shares outstanding. In this case, you earned 70 cents per share. Last year, you earned 61 cents. That number can be manipulated in a number of different ways, which I won't describe on today's video. Broadly, as an investor, most investors are paying attention to top line revenue, which is the money you're bringing in, and they're paying attention to operating profits here, particularly the growth of both of those, or in some cases, the decline in those. The higher revenue growth and the higher operating profit growth that you have, your stock tends to do relatively well. Now, we're going to come down to something called the balance sheet. Think of the balance sheet as maybe like your assets and your liabilities as you sitting there as a human being watching this video. So some of your assets are going to be the cash that you have in your bank account. Maybe you have equity in a house, maybe even in a car or something like that. Maybe you have some jewelry laying around. Anything that is worth something, that is essentially the asset side. Now, you also probably have some liabilities. Maybe you have some credit card debt. Maybe you do have a mortgage. Maybe you have some equity in your house. That would go on the asset side, but then what you owe on the rest of that house would go down on something called the liabilities, essentially kind of what you owe. And so what a balance sheet does is kind of show you the balance of that. So you've got your assets always on top and you got your liabilities on bottom. So we'll walk through the assets over at Walt Disney, you've got your cash and cash equivalents. That's exactly what it sounds like. This is if the company went to the straight bank. Now, they don't have $8,470. Thank God they don't have that little money. Again, these figures are in millions. So this is over $8.47 billion worth of cash. They have something here called receivables. This is money that is owed to Disney, maybe from affiliate fees or different types of things. It hasn't come to them yet, but at some point, most of these people will pay Disney this money. And that is to the tune of over nearly $14 billion, $13.99 billion. They've got inventory over at Disney. I would assume this is a lot of the inventory that you see in the parks. That is about $1.8 billion. You have content advances. My guess is they get paid up front for these types of things to the tune of $1.3 billion. And then they have something called other current assets, which you'd have to dig into the 10K to understand. That's $1.3 billion. So you got your total current assets. So there's something called current assets. And then there's something called kind of non-current assets. Your current assets is anything that you kind of can tap into immediately or really quickly. So it's the cash in your bank account, it's money that is owed to you very shortly, and it's inventory that you might be able to liquidate if you have to. Now, company has nearly $27 billion worth of assets. When you're looking at the balance sheet, you're looking for large discrepancies year over year. It's relatively the same. Then here's where all of the assets lie over at Disney, because you're going to say, this company is worth $203 billion on the open market. They have, $8 billion in cash, another 14 in receivables. That's not a lot in the context of $200 billion. Well, again, what is this company all about? It's all about that produced and licensed content. And they recognize it just as a cost. So they've spent $36 billion. It's actually worth more than that, worth way more than that. If they were to put this stuff on eBay or in the open market, obviously, media companies would be lining out the door to buy this. But from a financial perspective, they likely have to recognize it only as the cost. You also have those parks and resorts and other property. Look at this. Your attraction building and equipment is worth over $68 billion. So this is why this company doesn't have a ton of cash, is because they have to sink money into building those like castles and things like that over at Disneyland. And you see year over year, it is up. There's accumulated depreciation here. We won't get, for the sake of this video, we won't get into that. You have land and other projects in progress down here, over $1.1 billion worth of land. That's a lot. You have other intangible assets. Those are things that are hard to put a value on. You have something called goodwill. When Disney makes an acquisition, they pay over and above usually what the company is worth and the assets of what that company is worth. And so they recognize that here on the goodwill side. This company makes a lot of acquisitions over the years, so they're recognizing this is obviously a big number, over $77 billion. In fact, it's the largest line on the balance sheet is actually something called goodwill. Again, when they acquired ESPN, when they acquired Hulu, they had to pay a premium to bring that into the company. The company, when they acquired Hulu, when ESPN was acquired, some of those assets like the cash and some of the property, plant, and equipment, that's recognized on the balance sheet. But you got to recognize that premium that you overpaid for. That's recognized here in goodwill to the tune of $77 billion. And then they have other assets here as well to the tune of $9 billion. Total assets on the company almost matching the market. You don't always see this, but it's almost matching the market cap of the company dollar for dollar. Company's worth about $204 billion, and you have about $202 billion in assets. Now you come down here to the liability side. You have current liabilities, just like you have current assets. These are assets you can touch and feel very quickly. You have current liabilities. These are things like your car payment over the next 12 months. This is your mortgage payments over the next 12 months. This is maybe any other type of bill that you have to, maybe like an insurance bill that you have to pay over the 12 months. This is essentially a total of that. So something like they have the current portion of borrowings here. So this is all the debt payments that you have to make over the next year. Think about this as the cumulative payments of your mortgage or your car payment over the next year. Accounts payable, these are salaries and those types of things. This is something that they have to pay out over the next 12 months. You come down here to non-current. They don't label it. I think they should for the sake of this video, but you have your non-current assets below that. And here's your borrowings. This is essentially like bank debt. Think of this as like the total you owe on your mortgage or the total you owe to pay off your car. Up here on the current portion, it's just what you owe over the next 12 months. Down here is the total. If you wanted to pay the thing off to zero, That's the total. And notice this big, gigantic number, $45 billion worth of borrowings. And again, the company has to do this because they're building out these attractions and they monetize that over a long period of time. Okay, you build a castle at Disneyland and it's probably going to stay standing for a long period of time, and you're going to collect ticket fees over a real long period of time. You have to sink a ton of cost into it up front, but you monetize that over a long period of time. That's what a kind of depreciation is to a certain degree. But also think about it from the content side. Okay, you have to produce a movie or a TV show, and you monetize that over a long period of time. That is where your borrowings come in over at this company. They borrow this money to kind of finance that cost, and they pay that back as that asset is monetized over a long period of time. That is essentially the difference between your assets and liabilities over this company. There's some other stuff here on the balance sheet, but from an investor perspective, you tend to really only focus on cash equivalents. In the case of Disney, some of their other gigantic assets like the parks, like the content assets, like the goodwill, considering they made some wise acquisitions. And then you come down here and you just look at the debt as well and see what that cost from a financing perspective. Now, the last document, I promise this is the last document we're going to go through. And if you can understand a cash flow statement, you are in the top 1% when it comes to financial literacy. A cash flow statement is a very difficult thing to understand, but I'm going to make it as simple as possible. And I'm only going to show you the things that investors care about. Now, the first thing on a cash flow statement is you pull down a net income number. Where do you get net income? Here's $1.36 billion. Last year in January, it was 1.2. Let's focus on this $1.36 billion. Where did that come from? This is the top number. You pull down net income. If your memory is good, you remember what net income is. It is the quote bottom line on the company's financials. It is usually represented by these two black lines. Now, when you come down here to cash flows, you'll see it's this $1.361 billion. Disney, from a financial perspective, always some weird things going on whenever you look at these financial documents. They're pulling down this number, which is a net income from continuing operations, which means maybe they sold off a TV network. Maybe they closed something that was operating from a financial perspective last year, ceased those operations, or they maybe sold that to a different company. For all intents and purposes, $1.36 billion and $1.279 billion are pretty much the same number from a financial perspective, believe it or not. Now, in a cash flow statement, you are adding things back in that are non-cash, like depreciation and amortization. You build a big, tall building over in Disneyland. You capitalize that all up front. You have to pay $15 million to build the thing. Well, from a financial perspective, you have to depreciate that over time. We won't get into a long discussion of what that is, but essentially, that's not cash. That's just something the financial regulators want you to do. You do that across the board when it comes to financial statements. The one thing that you'll see a lot on software companies and tech companies like a Google or an Amazon is they pay their employees a lot with stock-based compensation. So most of those employees get a base salary, maybe it's $100,000, but then they get stock options on top of that. Well, that's not cash, okay? It's Google stock, or in this case, Disney stock. They call it equity-based compensation, and they awarded $270 million worth of that over the last quarter. Again, these are in millions, so when you see 270, that is $270 million, again, in a quarter. That is not cash. That gets to be added back in. So you come down here. It's not really important to understand all these add backs and subtractions. The two things you need to understand on a cash flow statement is you pull down a net income number at top, you get to add and subtract things that are not cash, and you come down here to cash used in operations. It was negative. It was negative over at Disney to the tune of $974 million. Last year was also negative to the tune of $209 million. This is another reason why, again, the company doesn't have to fire 7,000 people. And I feel for anybody that loses their job. But remember off the top what I said. This company's number one obligation is to the shareholders of this company. It's to the owners of the company. Who are the owners? It's the people that buy this stock at $111.78. And these people that bought this stock 5 years ago at $103 and this stock is at $111 is kicking themselves, because we could pull up a chart of, say, a stock like Tesla and look at over the last 5 years. 5 years ago, Tesla was a $20 stock. It is up over 870% to where each share is worth over $200. So investors in Disney are saying, why the heck 5 years ago did I buy $103 worth of Walt Disney stock when I could have bought 5 shares of Tesla and been up a huge amount of money? And so this company's obligation is to shareholders, which have a choice. If you invest in the Walt Disney Company, you're taking $1 that you could put in Tesla, you could have put in Apple, or any other company out there. So that's why when you see the company laying off people, it's in response to shareholders not being happy, and they're not happy with negative cash flow. You want to see a positive number here, obviously. That is because you still have investing activities over at this company, investment in your parks and resorts. Every quarter, this company is dumping nearly $1 billion. That's right, over $300 million a month back into the parks, repairing things, painting things, building new rides, repairing the different rides. Last year, they spent $981 million. This year, $1.1 billion. And then I talked about how the fact they've got this debt that they've got to repay. So in the most recent quarter, they paid $1 billion. In fact, they probably were obligated to pay down $1 billion worth of debt. They actually borrowed about $800 million. They borrowed another $67 million here. They paid the bank back $1 billion here. There's some other line items here related to acquisitions, but essentially this company, you come down here to a very important number as well, net change in cash year over year on a quarterly basis. Company burned through over $3.1 billion. That is a problem because as we go up here to the balance sheet, yes, the company has $8.5 billion worth of cash. They've got another $14 billion in what people owe them. They've got about $27 billion worth of total assets if they were to kind of liquidate kind of their current assets, not the total assets, but it's kind of the current assets. Well, if you're burning through $3 billion a quarter over the course of a year, that would be north of $12 billion. That would take down your entire cash balance to zero. You could not do that and operate this company. They've got to get these cash flows more elevated. And that, folks, is the last document in Disney's financials. Give yourself a pat on the back if you made it through this far. Thank you to Cartoon Brew for bringing me here on the channel. If you have any questions, you can leave a comment down below. You can also reach out to me at the Investor channel here on YouTube. I would love to help any of you out if you have any questions, whether it relates to Disney or any other media company or any other stock for that matter. Feel free to reach out to me anytime, and I will try to help you the best I possibly can. Have a wonderful day out there. I hope you enjoyed today's video, and maybe we'll see you again soon here on the channel. Thanks again, and good luck with your investments.